Welcome to Money Matters TV. I'm Patricia Dunn from the Dunn Wealth Management Group at Merrill Lynch in Conshohocken, Pennsylvania. And today my co-host is James Chan, a PhD and owner of Asia Marketing and Management. Now, both Asia and the United States are very much involved in this pandemic. So I'm going to take a few minutes to talk about how investors are reacting, and James will share what's going on in the international trade markets. Now, in prior programs, I have shared with you that there are 4 levels of service within the financial services industry. There is the do-it-yourself market, there is the automated advice market, there is the generic advice market, and then there is personalized advice market. And as you know, wealth management, and where I sit, is in the wealth management stage, the personalized advice. But in the last 2 months, I've had several people on the first 3 levels reached out to me with very interesting stories that I felt are worth sharing. The first one came from a LinkedIn connection. The gentleman reached out to me and shared that all his life he had done all his own investing, and that at this point he was very happy with his collection. He had mutual funds, he had ETFs, he had individual stocks, but the reason he wanted to talk to me is because he thought with the pandemic there was the real risk that he would be forced into early retirement, and he had no idea what this collection of investment instruments could afford him in the way of a retirement lifestyle that was feasible. So clearly he was ready to step up to personalized advice. Now, the second one was not nearly as positive. This was a referral from a friend, and the gentleman shared with me that he did all of his investing online, that he answered the questions that the computer posed, and the computer led him to an asset allocation. But he wanted to talk to me because the computer would not answer a short-term issue type question. So I asked him what it was, and he said, well, the market's clearly going down, and I'm afraid of losing money. So I think the best course of action is to sell everything, wait till life calms down, and then restart my investment program with the computer. And I want you, as a professional, to tell me that I am thinking correctly. I told him I could not say that I have never been a fan of selling low and buying high. But the real issue here was, what path did the computer have him on? What was his asset allocation? Because asset allocation has more to do with future success than short-term trading. Well, fear is an overwhelming emotion, and he was not ready to go there and discuss asset allocation, and became abundantly clear that when I would not bless his thought process, that he would have to make this decision on his own. The third was much more promising. This gentleman again reached out to me through LinkedIn and explained to me that all his life he has used various providers that all are of the 1-800 talk to a human type. And I shared, yes, that's generic advice. He said, well, I have a question that my providers are not in a position to answer. So I asked him what the question was, and he said, Pat, I'm really worried about inflation. I see Philadelphia raising their taxes. I see higher prices at the grocery store. And as we come out of this pandemic, I'm afraid of inflation eating away at my portfolio. I'm happy with my portfolio, but I want to know how to protect it. And should I be looking at trust accounts? And if so, what kind? And I said, well, we do trust accounts, so I can help you there. So clearly he was beyond the scope of a generic advisor and needed to step up to a professional that is in the personalized advice space. Now, that's where I am. And I've had friends ask me, Pat, is your phone ringing off the hook? I said, no, it's very quiet when it comes to wealth management. We make most of the calls. And the reason being is because personalized advice is much more comprehensive. It goes way beyond the portfolio. we discussed things like trust accounts and life insurance and long-term care coverage and mortgages and lines of credit. Everything that we do is financial plan based. It's goals based. So therefore, when wealth management is done right, it leads to a sense of calm. And this was beautifully explained in a conversation I had with one of my own clients about 2 weeks ago. I called to check in on her, and she said to me, Pat, the world's crumbling around us, but I feel confident where I'm headed. Well, let me tell you, that made my entire day. And I couldn't have said it better, that this is the calm that comes out of personalized advice, which is the core of wealth management. So now I'm going to turn it over to you, James, and share with us what's going on in the international trade markets.
Very good. Well, first of all, it's good to see you virtually without taking the bus, which I'm still afraid of, even though I can drive to the normal, traditional Freelicam studio. I am happy to report that China has opened up and people are working. I get to talk to people every day. They are still 12 hours ahead of me, so I get up early and get all the market information that I need. And I am happy because I know of two companies, which I know very intimately, making good profits, selling 100% American-made products, manufactured products. One company makes machine components, very sophisticated, precision-engineered machine components, and the company is doing very, very well, even in these pandemic times. And the other is a medical device company. And again, they are selling a product that, despite the fact that Chinese manufacturers are making them too, but they don't make them at a quality level that can fulfill the requirements of the more high-end users. So I'm using these two examples to tell people there is still life and profit selling 100% American-made products, and for that matter, services too, to China. And however, these are the good examples, but there are several trends that, to me, remain worrisome. And the first one is I used to be giving talks all over the Philadelphia region because I was part of the U.S. government's export promotion council. So we give a lot of talks. And lately, in fact, over the past many months, many of these talks don't appear. And of course, the pandemic is not helping. So I see that people kind of are retreating internationally, which I find quite regrettable. And the other thing is this US-China spat, which keeps going. Now, it's not as bad as before. When I say before, I am referring to when I was still a graduate student in Ann Arbor. I'm wearing my University of Michigan Life member jacket for this very reason. When I was a graduate student working on my PhD in Ann Arbor, Michigan, America and China were definitive hostile enemies. There was no trade. So I grew up in a very adverse environment. And so I don't think that we're there yet, but I'm not very optimistic that we are getting along as well as we did 10 years ago, 15 years ago. But so in conclusion, I think that for people who are determined to explore the international market, China and Asia are still viable options. There is money to be made if you're determined.
All right. Well, it's interesting because I think you just answered our viewer question. Our viewer question was from Caden Arando of Philadelphia, and he said, how do you think trade will change with Asian companies after this recent downturn in the economy. Is there anything more you want to add? Because I think you did answer the question.
Well, only in part. Only in part. I can add 2 points. First of all, let's talk about China first. Whatever policy the current administration has set, there is a definitive kind of decoupling. That's the word they like to use, meaning people are not really very friendly anymore, and our trade with China has declined. But while it has declined, the first point I want to make is that China is beefing up its efforts to do more business with neighboring Asian countries, and at the same time, despite the fact that people talk about, oh, don't make stuff in China, bring jobs back, but in real life, really very few jobs have come back for that very reason, but rather the jobs are moved. The outsourcing is moved from China to Malaysia, Indonesia, Bangladesh, Sri Lanka, India, you name it, all these other Asian countries. So I expect that more business will be done among countries in East, Southeast, and Central Asia than before. And if America does not want to play ball, I think these countries will then play harder among themselves, with or without us. I don't think that we have to come to that, but we shouldn't come to that.
Okay. Well, if any of our viewers out there have any more questions that you'd like answered, this is how you do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Our guest today is Doug Helburn of Hepburn Financial Advisors in Phoenixville. Hepburn is a CPA, a personal financial specialist, a certified financial planner, and has a master's degree in taxation. He is an investment advisor representative of and offering securities and advisory services through Cetera Advisors, LLC. They are a broker-dealer and registered investment advisor and a member of FINRA and SIPC. Cetera is under separate ownership from any other named entity. Welcome to the show.
Thanks for having me, Pat, James.
Hi.
It's great to be here.
Since you're on the fourth level along with myself, I'd like to ask you, what should people be doing now in this volatile environment?
Well, that's a great question. I mean, oftentimes people, when we're faced with the amount of change that we've seen, they want to try and get too out there in terms of the strategies that they're trying to implement. But the reality is they really need to come back to basics. So the first thing that I like to do with clients is sort of triage the situation. We have a number of people who are out of work right now. First thing they need to do is look at cash flow and budgeting. Has their income gone down? And what are they going to do to replace that gap in income? Theoretically, and as you know from the financial planning process, people really should have about 6 months of expenses in stable short-term investments like bank accounts or money market funds. And so that's really kind of the first place to go to fill that gap. And if that gap isn't filled and you still have a gap, then you need to start looking at cutting expenses. Now, that doesn't mean taking a meat cleaver to the budget, It may mean, tiny little cuts in your expenditures. And what we found is that actually smaller cuts over a longer period of time have a tendency to last longer and have a bigger impact than those that are really austere. Because let's face it, who likes to live in times of austerity? Not many of us. So,
Doug,
yes,
may I ask a question?
certainly.
Which is kind of a trauma-producing question, particularly for people who are no longer teenagers or in their mid-30s or early 40s, boomers, baby boomers, my age, and there is a fear, as Pat mentioned earlier, of suddenly your investment can just drop with no fault of the investment advisors, just drop by 50%. That fear, it may not come true, but on the other hand, it's a real emotional fear. What do you say to clients who are kind of crawling up and down the wall with that fear?
Well, that's a great question. And, as part of the wealth management and financial planning process, one of the things that we do with all clients is go through a risk tolerance questionnaire. Many people are probably familiar with this, where it asks, what's your time horizon? If the market dropped 10% this year and 20% next year, what would you do? How soon would you sell? And oftentimes clients hate those things. It's as bad as going to the doctor or the dentist, I should say. No slight to dentists or doctors, but the reality is when we have periods of volatility like this, it really kind of brings out whether or not people were truthful on their risk tolerance questionnaire, because oftentimes, if they're not able to accept the kind of volatility that we're seeing in their portfolio, then perhaps they're invested too aggressively. Now, that's sort of hindsight. If somebody is invested more aggressively than they should have, and now they're finding out that, well, maybe I should have answered that question a little more conservatively, that's another story. But the important thing in my mind, and certainly with my clients, particularly those who are in our age group, who are either close to retirement or looking to retire, is go back to the financial plan. Because when we get together with clients and we develop a strategic plan, the plan itself takes into consideration the volatility in the markets over the long term. Granted, short-term fluctuation is bound to happen, and we can war game that as often as we like. And in some circumstances, it's going to have a bigger impact, particularly if it's closer to retirement than if it's further out on the spectrum. But it's those discussions that, in conjunction with the risk tolerance questionnaire and the cash flow modeling, that really bring out, are you going to be okay? And rerunning those projections is actually probably one of the best things that any advisor can do for their clients, to be able to give them the comfort that, yes, the market has dropped X percentage, but you're still going to make it through. There shouldn't be an issue.
Yeah.
I agree, Doug, completely. And your comment earlier about having enough cash on hand to carry you through those rough times, which then allows you to leave the portfolio alone, is one of the smartest moves you can make, but it's also one of the biggest mistakes that investors make. I'd like to switch gears a little bit, because I'd like to have your take on whether or not now is a good time for people to be looking at life insurance. What are your thoughts?
Wow, I think that's a very important question, and for a couple of reasons. First off, we've seen this pandemic where a number of people have lost their lives. Granted, most of them have been older, in nursing homes, with some type of comorbidity. But the reality is, if you have a permanent life insurance policy, you should be having that reviewed each year. Mm-hmm. Obviously, because the life insurance company, when you purchase that policy, they made projections based on certain assumptions, and there's a wide range of assumptions that they can use. If those assumptions change, or if their either cost of insurance or their policy costs go up, that can significantly impact the performance of the policy. And so it's important to get that reviewed on an annual basis, even if it's a fixed life insurance policy. If it's a variable life insurance policy, which, of course, are sold by prospectus and the cash value has the potential to go down, that's another story and requires a much more detailed analysis. But I think it's certainly important for people to look at that. For example, if people are short on cash, you can always borrow from the policy. I don't necessarily recommend it because the cost of borrowing from a policy is oftentimes higher than the crediting rate in the policy. And in addition, it has the potential to impair the policy long term. So a lot of the questions that surround life insurance are fact specific and really require a good eye on what's really in the best interest of the client.
All right. Well, now some people feel that they have enough money and they don't need life insurance. What do you think about that? You know what?
It's quite possible that they may. It really all depends on the client's objectives. For a long time, when you think about life insurance, when you think about insurance in general, why do people buy it? They buy it to reduce or eliminate a risk that may have a significant impact on their financial plan. For example, you buy auto insurance. Why? Because it's mandated by the state, but two, if you get in an accident and God forbid you're liable, you could be bankrupted. So the insurance company is there to try and cover that risk. We buy homeowners insurance. Why? Well, if your house burns down, you could be out of a house. Well, if you need insurance, if you don't need insurance because your income is covered and you have significant assets, that's a fine position to take. But once you hit about $11,580,000 in assets or $23 million in assets as a married couple, then you start getting into the estate tax. And for a long time, life insurance was used to replace those assets that were going to the estate tax, so that the taxpayer could be made whole, or at least their family, their survivors. I think with a lot of the stimulus and recovery packages that we're seeing, you're going to hear a lot more discussion about lowering the exclusion rate on the estate tax and possibly coming back and affecting more and more people who may not have as much wealth as some think, or as the current structure allows for.
James, you have a question?
Well, I can't resist going back to what you said earlier about the 4 categories. I think it's 4 of investment advisor services. And I think you emphasize, and I completely agree, that in a chaotic time like this one, we really need a lot of person-to-person kind of voice holding, if not hand holding, so to speak, that people need to talk things through. Particularly, I believe that more times than not, people really don't know what they want unless someone with a sympathetic ear who is also able to get your fears out so that you can look at them in order to find out for yourself, let alone for your financial advisor, what you really want out of life, like what is really most important. That generally people don't know it, or they don't want to talk about it. I think I'll shut up at this point, let the two of you react.
I couldn't agree with you more, and I think Doug makes an excellent case here. And so Doug, Trading on what James just said, having a sympathetic ear to talk to, which would be someone like yourself or myself. The question right now in this pandemic is, what about the topic of nursing homes? Should people be looking at their plans for nursing homes at this stage in their life?
Absolutely, absolutely, and that brings up a number of issues. But just to sort of follow through on what James said, I think having a sympathetic ear is important, but probably more important than anything is being able to speak with somebody who's going to be objective. You know, we all have our own biases, and so, as Abe Lincoln said, you know, a man who acts as his own lawyer has him a fool for a client. To have a good financial advisor as an objective person, an objective set of eyes to look at your situation is critical. Now, back to long-term care and nursing homes, you know, long-term care is something that I know people have talked about for years, but oftentimes either wait too long to get it. The latest issue age, I believe, is 79, 80. Once you hit that point, you can't get it. But with the recent pandemic, one of the things that we're seeing is that all these policies that were sold that were basically term policies where people would have a benefit for X number of dollars per month for 5 years or 60 months. That made sense. But now that we're seeing mortality rates go up in nursing homes because of this, once you die, the benefit's gone. There's nothing there. And so I think what this is going to do is going to cause more people to consider what are known as linked benefit policies, where people have the ability to have some kind of cash value, some kind of death benefit, yet still be able to have a resource available for to cover long-term care expenses. And so I think we're going to see a big uptick in interest in those types of policies.
I absolutely agree with you, Doug. Unfortunately, we're just about out of time here, and I did want to let our viewers know who our next guest will be on this program, so you can be sure to tune in. Next week's guest is David Noteware. David is a serial entrepreneur who is a driver of growth, and he's out of the Salt Lake City area and actually is a professor at the University of Utah. So I'm sure what he'll have to say in this environment will be most interesting. And remember, you're always welcome here at Money Matters because your money matters.